Thank you for having me on. Look, first I want to thank our colleagues around the world for delivering an excellent set of results. RevPAR was up 16% for the year, as you mentioned, 8% in the final quarter. And look, we're still growing. We opened 275 hotels last year, 556 hotels were signed into the pipeline with one of our strongest fourth quarters of signings on record. So really, it's a testament to our strong enterprise, a powerful brand portfolio, and a very strong enterprise that keeps compounding growth for shareholders. I mean, that drove our operating profit up over $1 billion for the first time ever, up 23% year on year, EPS up 33%. We returned $1 billion to shareholders last year and announced that we're going to return over $1 billion in 2024. We saw growth, to your question, we saw growth around all the markets around the world, whether it was leisure, business, groups and meetings recovered, and it was really across all the markets, US, Europe, and China too.
Elie, talk us through hotel pricing, because at this point, it feels as though we're still seeing consumers pay more at this point in the cycle for hotel rooms than they would have paid in the past. A lot of even high-end spenders that I know are complaining about the prices of hotel rooms. What's the ability to keep on pricing up from here, or are you seeing demand destruction now?
Yeah, the first thing I'd say is we have a stay for everyone. Yes, in our luxury and lifestyle hotels where you're really looking to treat yourself, whether it's for a holiday or a major event or anniversary. But, in our Holiday Inn, Holiday Inn Express hotels that are about 4,000 of them around the world, we have a stay for everybody at a very affordable rate. When you think about it, for inflation and hotel rates, it really hasn't kept up with consumer price inflation around the world. Whether it's in the US and Europe, just in 2023 did hotel rates really keep up with inflation. The second thing is most hotel pricing increase is not, consumer like-for-like price increase. It's really remixing of the groups and meetings and the different consumer segments that we take in a hotel. So as the market strengthens, demand strengthens, and supply has been pretty low, our hotel operators will change the mix of customers they take, of groups that they take, of companies and contracts that they accept. So it's not always the same consumer paying more for hotel stay. It's just different consumers paying. But we did not, really reach inflation-adjusted room rates until 2023.
Elie, good to see you this morning. So there's a lot of good news in this statement. I can see that just from looking at it. But you made a comment back in October, and I want to just see if you can just update us on the situation there, where you said funding challenges are holding back new hotel development. Is that a problem for the franchisees at the moment, becoming more exacerbated, or just talk us through it?
Yeah, look, I think we're seeing an improving environment. You see interest rates have leveled off. Inflation has leveled off. They've come down from the highs of growth. We're seeing construction pricing improving around the world. Supply chain issues have resolved themselves. And you can see that in our results. We opened 275 hotels. We signed over 515 to our pipeline. Our fourth quarter signings were 50% more than the prior year. So we're seeing an acceleration, and that was really across all of our markets. We signed nearly 80,000 rooms in 2023, with about 25 to 28,000 in each of our major regions. So it's pretty well distributed around the world, very well distributed across our brands, from mainstream to luxury and lifestyle. So I think we're seeing an improvement in that climate. There's still more to come, though.